wealth is a kind of catch-all term to summarize like where you're at in terms of your current capital. Capital, I then split into three main tranches, as you've heard me talk about, which is the financial capital at your disposal, the human capital or humanistic, and then the intellectual. Now, of course, financial capital is much easier to measure because we have money in which to do so. So, money ultimately is a technology that solves the double coincidence of wants problem. Money is the other half of every trade you ever make for services, for products, or you selling your own time, etc. It's in receipt of money, or you give money to receive something. And therefore, we can use price. And so, whatever money you might be using, whether that's Aussie dollars or British pounds or euros or gold or silver or bronze or glass beads, or, you know, you will have heard stories of people trying to buy someone's sister or wife, perhaps on a trip from the UK to Africa for some sheep. I mean, it's money is everywhere and everything, but some things are much better at being money than others. And Bitcoin, in my opinion, is the latest iteration of a long-held problem that humans had, which is the double coincidence of wants problem. In a barter economy, how do you swap 6 oranges for 1 apple? It's very hard. Well, money solves that problem. And so money is a way to price things and ultimately value. So language, the language of value. Like, how do I value something? And this is where you end up diving down into, or I ended up diving down into the Austrian School of Economics, which is a field of economics that's not widely taught. The closer you get to it, the more obvious it becomes as to why, in that it is a proponent of free market philosophy, proponent of libertarianism, and it does a very good job of explaining why government intervention is a net negative. And so, unsurprisingly, the governments of today, in cahoots with the money printer and the monetary scientists and the policy scientists working together, they like intervention, right? And then they can pay for it on the back end with the money they print. And so the Austrian School of Economics is this whole other world in which you could operate economically. And that's where the phrase sound money comes from. So before I digress too much into like what is money and the history of money and the Austrian School of Economics, what is wealth? Well, in a lot of cases, your wealth is really your time. How much time do you have to yourself? And when I think about my day, like I've got to the point now where I feel very wealthy in that I'm not having to exchange most of my hours for a fiat employment contract. And the day that I really got my head around the fact that that was actually possible was probably one of the wealthiest I'll ever feel. It's like, oh wow, I control my own time. I'm not having to rush to a place of work to get paid 340 days a year. I actually now have the time and space to take a step back to focus on my marriage, focus on being a father, and focus on my own health. And with that, it's interesting in the space that it created for me allowed actually my investing to improve hugely. Like the returns I have got since relinquishing this kind of it's really hard. It's almost like an inherited trauma towards got to work, got to work, got to work, got to work, like a hamster. And when you come off the hamster wheel, you're like delirious. Like, what's going on? This doesn't feel right. This isn't. I should be in an office right now. Where am I? This is wrong. I'm not allowed to do this. But with that extra space comes new ideas, comes additional creativity, and in my opinion, improved decision making. And improved decision making is basically investing. So you make bad decisions, you lose your money. You make good decisions, you make your money. And that is capitalism. And that is not a dirty word. Unlike what a lot of the mainstream kind of champagne socialists will have you believe, capitalism is a great thing, and it should be something that we really try to empower and unleash, and it, in my opinion, enables human flourishing. Again, not to go on too much of a tangent, but Jake, how do you calculate your net wealth? Well, okay, what the combination of your intellectual, human, and financial capital is your net wealth. Now, how do you actually calculate your intellectual skills? How do you actually calculate your humanistic capital? It's not altogether obvious, and they're more qualitative rather than quantitative responses. I've got 3 kids, they can do X amount of work, or I've got 10 cousins and they can do X amount of work, or I'm qualified in, whatever relationship you might have. And then the intellectual side of things is like, okay, well, per hour I can bill X because of my qualification, whatever, or I learned to build and scale companies, or I have a social media following, or whatever your area of expertise might be that generates income and generates capital growth. So those are harder to quantitatively measure. So the easiest thing that we do is we measure our financial assets. It's like, okay, well, if our total financial assets can be calculated using the money of the day, then let's do that. And so thanks to Jin and some coaching I got from her, I now every week put together a statement of assets that I share with my wife. And I'm looking at, okay, well, where are our investments today and what are they worth? And how much of that is in equities? How much of that is in cash? How much of that is in, I mean, Bitcoin is essentially cash. How much of that is in jewelry? I mean, whatever you might own, people own lots of real estate, or they own classic cars, or they own artwork, or, you name it, right? There's, any number of things you can own, limited edition trainers, whatever you're interested in. What is the total of all the stuff you own? And that is your assets. But importantly, you then have to think about, what are my liabilities? So, okay, well, I've got this credit card debt, or I've got a lease on this car, or I've got a mortgage on this house that's worth whatever it might be. And so you then got to balance the books. This is the idea of a balance sheet, right? So, okay, well, what is all of it added up? And then you take your assets and liabilities, and what's the final figure? So, okay, well, on my statement of assets, every week I have a net wealth in Aussie dollar terms, but I also calculate it in British pounds, and I also calculate it in Bitcoin. And it's been fascinating recently watching it fluctuate, especially in Bitcoin denomination, because unlike what we're used to, which is basically up, 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 up equals good in pound or dollar terms, Bitcoin is deflationary, so it's decreasing. It really screws with the head, this, because on a chart, you're normally looking for that up and to the right. But actually, the future productivity growth in combination with the deflationary currency, good equals down and to the right. And I admit this is not something I've got my head around at all. So I'm going to do some more work on that. And that's what's fun about these solo rips. Okay, I have to go back and figure that out. So, okay, calculate up all of your assets. What do you think they're worth today? Now, some things are super liquid, like the dollars in your bank account. You could get those tomorrow, subject to not being frozen by the bank or something. But your house, oh, it was last valued when you bought it 3 years ago. Well, what do you think it's worth today? Okay, well, you might be able to calculate based on some local sales what you think it might be. And there's a really interesting bit of work that was done. If you go to look at the Nakamoto portfolio, shout out to the guys that built that, there's a very clear guide that like property prices are actually very volatile. But because of the illiquidity of them, they don't mark to market every day. So you're not buying and selling the same house every single day of the year. You buy and sell it maybe once every 5 years. And so the actual price paid can look more steady than the actual market is. And that's just due to the nature of the volume of transactions. It's just much, much smaller than people taking cash in and out of a bank, or equally people that trade the S&P index or whatever. Or, US Treasuries has traditionally been the risk-free return that an investor will look at as highly liquid. They're not going to go bankrupt, and you get paid an interest rate for giving them money as debt. You can get a pretty good understanding quite quickly as to like, what am I actually worth today in dollar terms? Okay. Now, the next bit I think that's important, and why your net wealth relates to your time, is actually then you want to look at something, what I would describe as, in startup language, at least, your burn rate. But I don't really like that language because it's a not very nice connotation. So think of it more as like, I tried to rephrase it as like the fun rate. And that's basically like, what is your life cost? And that obviously varies. Certain times of year, like Christmas, more expensive, or all the insurance contracts get paid at whenever time of year for your home insurance, your car insurance. All these bills pop up. Suddenly, it's all at once. Like, shit. Okay, I need more money this month. But most people are pretty on top of their expenses and how much their life costs. And with that, you then want to think about, okay, what is my net wealth divided by my annual run rate? And so, just to give a very simple example, let's say you're worth 1 million, and your run rate each year, you spend 100 grand, and therefore you've got 10% each year that has been eaten into your funds. So your net assets at the end of year one, if they do not increase in value, are now 900K because you spent the 100 on life. And so how I think through this is every single week I'm looking at, okay, what are my net assets today? Obviously assets minus liabilities. And then roughly speaking, how does that match up versus the money that we spend? And obviously, the longer the runway you have, the better. So let's say your net assets were actually 10 million and your burn rate is only 100 grand. Now these are random figures, but the 100K you spend a year, well, suddenly now you can live 10 times longer without actually going out and creating any income. It's that trade-off there that I think is the most important to measure, because obviously everyone's expenses are different, everyone's net wealth is different, you live in different parts of the world, you have different tax regimes, you might have kids, you might not have kids, you might be at a different stage of your life, and with that come different risk profiles. So I'm in my mid-30s, I've got 3 young children, I'm very much still in the wealth growth phase. Like, I'm looking to take more risk, I've got a lot of work time ahead of me, and I'm okay with that. Now that's really cool. Whereas if in 30 years time I'm 60, mid 60s, and you're like, well, I'm starting to think more about like slowing down and how do I provide for myself without generating value into the future, and that's a very different risk profile. 2 people come to mind here, which I want to just shout out to. One is Larry Lepard, who came on my podcast in the past. And Larry is just an awesome guy to learn from. And I heard him once say on a pod, it's like, shit, if I was in my mid-30s, I'd just be loading up on this Bitcoin stuff. But I'm not. I'm in my mid-60s. I'm a gold guy, or I was a gold guy. And so, I've got lots of friends that want to take a bit less risk than that. And shout out to Larry for so many of the lessons he's taught me and the content I've consumed of his. And the other here is then, okay, if you're thinking about your burn rate, your net wealth, okay, how long can I last for? It really comes back to this whole idea of time. And the more time you can buy yourself, the more space you have for new ideas to drop in, for new creativity to occur. And I think that's where really one can start to move the needle on one's happiness. Because with that extra space, the financial capital buys you the ability to reinvest into your human capital and into your intellectual capital. And you want to constantly be trying to balance those 3 buckets. So, another common thing that we come across is this idea of unhappy billionaires. Well, money solves money problems, but it doesn't make you a good parent. It doesn't make you a supportive spouse. It doesn't make you a good friend. You have to work on those things. And if anything, sometimes people have the opposite experience. It's like, why is that? Well, to me, that's a poor allocation of capital. And so it's actually not about being, the richest person in the world. It's not about being the most intellectual person in the world. It's about having a happy balance, which then gives you the space to enjoy your life. And that's ultimately what this is all about. So that's hopefully a good insight on like what is wealth. Well, wealth is really a combination of those 3 buckets, and ultimately can be compounded down to time and how much you can control your own time.